Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Amidst the ongoing tumult in the digital asset space, it was a pleasure to welcome Bill Birmingham, the Chief Investment Officer of the Osprey Funds, to the podcast. Originally trained as a lawyer and then transitioning to a role in portfolio management in the traditional hedge fund space, Bill shares his views on many aspects of the crypto landscape, at once excited by the potential for blockchain innovation, but also on guard for a further leg down in prices. Our conversation explores his early interest in digital assets a decade ago, fascinated by the programmable features of smart contracts and the similarities to what he'd observed in his study of law. We also spend time reflecting on the most recent systemic risk in the meltdown of Luna and the contagion impact of the 3AC default. There are lessons to be learned here and work to be done to create a more robust system. Specifically, the recursive leverage that is enabled through Bitcoin as an electronic bearer asset needs to be managed if the overall system is not to become too leveraged. Looking forward, Bill and his team at Osprey see promising innovations in the NFT space and opportunities to deliver exposures to end users on a cost-efficient basis. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Bill Birmingham. My guest today on the Alpha Exchange is Bill Birmingham. He is the Chief Investment Officer of the Osprey Funds, a firm doing some innovative work in the realm of asset management in digital assets. Bill, thanks for being a guest today on the podcast.
Thank you very much for having me. It's a real honor.
Yeah, excited to have the conversation. As I was saying, our audience is much more steeped in the realm of traditional finance than in crypto. And I thought we could really bring to light some of the work you guys are doing. We've got obviously a lot to talk about in terms of the recent risks that have emerged in markets generally, but certainly they've been protracted in crypto. And I think you're in a great position, just given your background in traditional finance and hedge funds, to really talk through maybe some of the nexus between traditional markets and the area of digital assets. So let's get the conversation underway and learn a little bit more about you, your career history. Tell us about how you got started, let's say, in the area of traditional markets to begin with.
I started in the hedge fund space in the early 2000s, right around 2001, 2002, so after the dot-com bubble burst. My formal training, my education is as an attorney. I spent a couple of years, I went straight through from undergrad to law school and spent a couple of years in Boston as a lawyer before getting the opportunity to join a startup hedge fund that was created by a group of guys who were sector specialists in the basic materials space, specifically in forest products. So we were a long-short equity hedge fund that was really dedicated to that particular niche. And we ran that for about 6 years or so. I was kind of a jack of all trades. I started out as an analyst and worked through everything as a founding member of the team. And unfortunately, we didn't survive 0809, but it allowed me to transition to a bigger fund, a tiger cub called Impala Asset Management, run by Bob Bishop. I was there for about 6.5, almost 7 years, and then ended up at a multi-strat called Carlson Capital based out of Dallas, run by Clint Carlson.
As we think about the transition that you made from the world of hedge funds and thinking about trying to find value in securities, maybe let's just talk a little bit more about your career on the buy side, just in terms of risk management at the hedge fund level. You said the first venture didn't survive 0809, just an onslaught of volatility and illiquidity in markets, and to be caught in the wrong place at the wrong time was pretty easy to have happen, just given the damage that was done to markets and asset prices. You spent some time in the aftermath at a different fund where vol came down, the Fed was quite active, perhaps too active in markets. When you look back at that career in traditional markets, what are some of the big lessons that you took away from that time period?
Well, one of the interesting things that has presented itself to me in hindsight was that the game really changed after 08, and I would argue almost after 07. To your point about volatility, the pre-08 market was a very different environment for running equities, certainly for a lot of different types of strategies. On the one hand, you had a very large macro trend that was exerting itself in the rise of Chinese demand integration into the world economy after they came to market in the WTO in 2002. And then obviously the leverage that was coming out of the housing sector was pretty extraordinary. And then since '09, the 2010 to now regime has been a very different game. And my takeaway is that you just have to always adapt kind of the environment that you're trading in and figure out what the rules are and where the alpha lies once the kind of the new regime changes.
You left the hedge fund, or at least the traditional hedge fund industry, and embarked on a career much more focused in the realm of crypto. And how many years ago was that?
So I started at Osprey in the beginning of 2021. I've been kind of in crypto, but not fully in crypto since about 2012, 2013. I found the asset class through a blog post. Actually, I'm a big follower of Tyler Cowen's, Marginal Revolution. And I think he, back in the day, published the infamous Bitcoin pizza transaction video, which really had gotten my attention. And the reason why is, and I think you hear this from a lot of people who were in traditional finance, particularly who had kind of a macro bent, more a top-down approach to their investing, which was if you survived that period, you certainly were a bit radicalized about the monetary system coming out of it. And Bitcoin was just such a revelation from both a technology standpoint, but from also just a store of value as a total revolution in money that really caught, I think, a lot of people who were in the macro space's attention, frankly, even more so than people who were in the technology space at the time. I think you saw a lot more people who were in markets find Bitcoin first for that reason. And so that was definitely my experience. I remember really having a light go off in that regard. Unfortunately, the light was not bright enough to tell me to buy thousands of them as opposed to just a couple, but it definitely piqued my interest. And then following on that, I remember when Ethereum was also first announced. I didn't catch the white paper, but I remember when the website went live and a lot of the news around that development really honed in on its smart contract capability. And having been a lawyer for a couple of years, I just was like super fascinated by taking all of that programming language, which is what law really is, and putting it into code, which was also just like an amazing thing. So I've been on the fringes of crypto for a while, and I've tried a few times to get involved in various ways from an investment perspective, but never found the right fit until Osprey came along.
Well, I'd love to learn more at a high level about just the features that can be embedded into these smart contracts along the way in our conversation. I want to go back to your early days in terms of finding this white paper, maybe finding that blog post and being really intrigued. And I'm thinking about the book, I want to say it was called Bitcoin Billionaires by Ben Mesrich. And one of the things that caught my eye in that book was the incident, and I certainly remember it more from a macro finance standpoint, just because my own work certainly led me to focus on the Greek crisis and the Eurozone crisis quite a bit because there was so much spillover back into US markets from this risk event. But one of the things he talks about the early days of Bitcoin was Cyprus, where effectively they crammed down depositors in trying to protect the country. So the bank depositors got crammed down. And this was one of the arguments made early days for the desire to hold something like Bitcoin. And if you look at the time series, that was a period where the price of Bitcoin went up quite a bit on a percentage basis, certainly not anywhere near where it is now, but you saw a big move. So take us just back a little bit, bring to life a little bit more for us the early days of your intrigue, learning more about it, the kind of maybe anti-central bank part of it versus or in combination with the technology parts of it. What were the components that really led you to want to study this and learn more about it?
One of the big draws to Bitcoin is the global nature of the system. And I think that where my experience started was dealing in emerging market resources in emerging asset classes. So, for example, we did a lot of offshore investing in timber. We did a lot of offshore investing in agriculture in South America, in metals and mining in other parts of the world. And I think if you do anything outside the US and just get a taste for how at risk you are for various monetary policies around the world and other types of regulatory regimes, it becomes pretty clear how much we take for granted in developed markets. And so when you see something like Bitcoin, and to your point about Cyprus and other places, it just really drives home what the real benefit of this protocol is with respect to being able to be a dense store of value for people who face very uncertain monetary and taxation outcomes. One of the stories I like to point to that happened even just as recently in 2021 was when Erdogan tried to influence the central bank of Turkey to mess with interest rates, and they complied, and the lira dropped by, I think, 20% a day, which corresponded to one of the largest increases in Bitcoin wallet creation in its history, which really tells you that for what is essentially a middle income country, emerging European country, to be so volatile, you had real middle class people losing their life savings over the decisions of a individual that were not in their control. And so Bitcoin allows people in a lot of these markets to essentially store value and try to escape from those systems. It's not perfect. It certainly hasn't achieved the level of fiat when it comes to kind of everyday life, but it's on its way. And I think people will see a lot of innovation in the space over the next so many years that is going to allow people in the global economy to participate in ways that I think we've not seen before.
I think there are people in the traditional world of finance who are very intrigued. They're watching the price accelerate higher, and then, of course, recently more of a meltdown in price, but a little stuck in terms of trying to gather the expertise or the working knowledge of the universe, not just of Bitcoin, but cryptocurrency in general. Walk us through, in that period before you joined Osprey, as you were learning more about it and engaged in some way. Talk to us a little bit about the learning curve and maybe some light bulb moments along the way as you became more compelled by the product or by the ecosystem. What does that learning curve look like for you?
So I'll be the first to admit that I'm not a computer scientist. I don't have a coding background. I wasn't even a software analyst, primarily in my hedge fund job. But I fundamentally believe, just as a person, if there's something that you're passionate about as an individual, you're infinitely curious, and if you're willing to put the time in, I think people can understand crypto in the same way they can understand anything else. One of the real joys of being in the buy side, particularly in the hedge fund, was the ability to pursue ideas wherever they came from and then just get up to speed on them using whatever resources you get your hands on at the time. So no one's born a chemicals analyst. You don't all of a sudden just wake up one day and know how an ethylene cracker works. You figure it out and you learn all of the various mechanics of it in order to make sure that you understand your investment. And crypto is no different. So the way I've kind of approached the space is to come at it in the way I've come at everything, which is taking a top-down approach from the macro side and then building up from the micro and meeting in the middle. And the building up part requires a bit more legwork because it does involve certain elements of technology that have to be learned, but it's not insurmountable. For me, what I've done is read as much as possible from the organizations that develop the individual protocols. So the great place to start is with a white paper. A lot of times, at least the beginning of the paper is pretty straightforward with respect to why the protocol exists and what it's trying to accomplish. And from there, as you start to kind of do your reps, you learn the various elements of the technology, and then things start to kind of piece together over time. I find that Twitter is also an excellent place for information. Believe it or not, crypto Twitter has a deep and robust community of people who are willing to share information and certainly pump their bags as well. But in general, it's a really good source of constant flow. And then getting out there, talking to people. I mean, crypto has had nothing short of a pretty big run of conferences over the last couple of years, and getting out and talking to people in the ecosystem is also very helpful.
So there are a number of problems or challenges in our current system that Bitcoin seems, or just cryptocurrencies in general, seem poised to try to address. I think the first is this notion of fiat. So I'd love to hear how much of that weighs in on how you think about opportunities. Let's just stay with Bitcoin for a bit. We've had some experiences here where the central banks seem improperly influential in asset prices and determining winners and losers and so forth. And their way out seems improbable to try to find them to actually leave the markets and let prices clear where they ought to. And then I think you also referenced it, the payment system in general. Moving money around the globe is really difficult in certain circumstances, if not impossible. So you reference this global network. What are the factors that, when you look at adoption in the future, that make you most bullish in terms of the problems that Bitcoin is trying to solve?
I'm approaching the crypto ecosystem from the perspective of the internet. And when I say that, I mean the internet as being the backbone of the global economy. I do truly believe that pretty much most of the value or economic value outside of just energy is now becoming intangible. And crypto is a way to own intangible assets. And it starts at the protocol level through these tokens. And the original one being Bitcoin. And so it has the biggest network effect. Also, the thing that Bitcoin has going for it is proof of work, the consensus mechanism that ensures that every block that gets put onto its blockchain is immutable and cannot be retroactively altered to adjust who owns how many. I think that innovation, the ability to bring money to the internet, is an incredible revolution for economic life. And the ability to store that in a block that's immutable means a lot. It means a lot. I think it's my previous anecdote about people living in less developed markets. It just means a lot to be able to do that with your hard-earned wealth. And what's interesting about Bitcoin to me in that regard also is that if you think about states having a vested interest in maintaining their monetary systems, the United States in particular, there will come a point where there is somewhat of a threat from crypto to those established systems, and there will be a reaction to it. And I think when that reaction comes, or if it comes, it will be almost impossible to censor Bitcoin. You can certainly do some damage to the system, but the ability to wipe out all of its nodes at this point is impossible, in my opinion. And if that's true, then that really sets up an incredible system going forward that will be able to kind of run in perpetuity as long as we have an internet to store value. That's really an incredible concept. It's an incredible concept in the same way that money at one point was abstracted away from coins into paper, into digits on a database at Bank of America. And I think Bitcoin's kind of just the next step in that evolution.
It's interesting. We sit here amidst 8% inflation. So you do nothing for a year and you're essentially 8% less wealthy on a standstill basis. It doesn't feel good, but relative to what folks may have experienced in emerging market countries where currency crises are all too frequent events, gosh, that's got to be the scariest thing in the world, to watch the money implode in a system. And so I think that this idea of adoption by other countries, and maybe you can comment, I think is it El Salvador that's adopted some kind of treasury function with Bitcoin?
They have. They've made it legal tender in the country, meaning that it has equivalent status to their national currency and therefore can settle all debts. It's an interesting experiment. I don't know how I feel about it being essentially a tool of the government, in this case, in El Salvador's case. I think it opens up the citizens of El Salvador to a level of noise in the system that's not necessarily in line with where Bitcoin's core use function is. I think one of the interesting things that we're seeing about crypto in general is this push and pull between bringing US dollar monetary policy into the system versus keeping it out of the system, which is kind of an interesting transition to DeFi and Ethereum and everything that's gone on in the last, I'd say, 6 or 7 months from a volatility perspective. But I'm kind of in the camp that crypto should evolve more natively, and the idea that you're importing US dollar stablecoins into the system, you essentially import its monetary policy, which may or may not be the best thing in the world for it.
Yeah, I always found that to be quite curious. I get the stablecoin as an on-ramp that's helpful as a lubricant, in other words, to go into and out of different assets within the crypto universe. But you're right, it kind of dollarizes it. You talked a little bit about the volatility in the space. And so I'd love to spend some time on, the last 6+ months. It's been clearly a very difficult time price-wise. Things probably had gotten well ahead of themselves with Bitcoin topping out where it did, and all of the other smaller tokens and coins also getting pretty pumped up there. Talk us through the last several months in terms of risk. What are the takeaways in terms of counterparty exposures? It seems like it's ongoing, but I'd love to get your rendering as an expert in the space on the last couple of months of volatility.
It's been quite something. I like to frame this market, especially the last couple of months of it, as both externally influenced and internally influenced. And from the external side, I think if you overlay the growth in M2 that occurred, just the explosion of liquidity that took place in response to the pandemic, you see a pretty strong relationship with crypto pricing. I think what we witnessed from a capital inflow perspective, it was like a perfect storm. You had the US government essentially sending checks directly to individuals. You had people who were either working from home or at home, and you had the entertainment element of markets that only go up. So all that said, there was this very strong tailwind from a macro perspective to this asset class that certainly had contributed to the rise in prices. Now, that said, what then kind of happened on the micro level inside of crypto is the nature of decentralized finance and the ability to create recursive leverage inside of the system. And that basically means, very simply, is that you are allowed to borrow in crypto as long as you post collateral, in many cases over collateral. But then you are also able to use what you borrow in some cases, or use what you generate from your borrowing to create collateral for another loan. And then it just becomes recursive in the sense that you just create more and more loans until you've fully maxed out your collateral ability. And so what we saw over these last few months were players essentially using that setup to create very large leverage and highly concentrated positions in the system. And when the overall macro bubble burst and liquidity started to be drained from the system, then all of these recursive loans fell back on each other. And that's what exacerbated the volatility and certainly pushed the drawdown to these extreme levels that we've seen so far.
It's an interesting, again, as someone who's much more in the traditional realm of finance, but has spent a lot of time studying risk events and trying to draw some framework for understanding the commonalities that occur. And when I look at this one, there's part of me that says, okay, 3AC is sort of the LTCM of 1998. LTCM, rock stars in the industry, were able to consume a tremendous amount of collateral, kind of threw their weight around as a counterparty. Everybody was eager to do business. But their trades were very opaque. They mostly traded OTC derivatives. So there's no ledger there. There's no tape. You can't look at it and say LTCM just sold a 5-year straddle on the S&P. It's all OTC. And so then in the aftermath, Merrill Lynch and Goldman Sachs and Lehman Brothers all saw how big the counterparty was, not just with them, but with everybody else. And I guess my understanding or my thought beforehand would have been that things like DeFi make that problem less likely, that there is more of a defined in plain sight ledger where we could see more of the risk exposures. Talk us through that, just in terms of how the industry got itself so big and so daisy chained in terms of collateral risk.
Yeah, I think your analogy to long-term capital management is very spot on here. I think that 3AC certainly fits the archetype of that event. And yes, on the one hand, there was an opacity here that should not have happened or unfortunately happened, depending on your perspective. It's an interesting argument because what's kind of where the community is tending to break, where the fault line is tending to break here is around the idea that centralized finance failed and decentralized finance actually didn't in this situation. There are good points on both sides of that argument. I mean, a lot of the opacity that you reference here that Three Arrows was playing in was coming from outside of the blockchain, outside of crypto, from essentially counterparties that were taking US dollars, converting them into crypto and then lending them to, or taking other people's crypto and lending them on their own balance sheet or through their own mechanisms to 3AC. So in a way, it wasn't a real problem of DeFi. It really was the old kind of model just being used in a different way here. On the flip side of that, what I referenced earlier about the recursive nature of it, that is a native DeFi issue. I mean, you can spin up a protocol and then create liquidity pools that issue tokens that can be used in collateral and other systems. That is very much fundamental to DeFi. And that also exacerbated the vol because at the end of the day, when those loans liquidate, there's no recourse. They just liquidate. And those tokens are sold and the market experiences the volatility. So I guess the real question is, where do we go from here? I think that in a lot of ways, this kind of episode highlighted what still needs to be done in the ecosystem. And part of that has to do with identity, to your point, like knowing who's exposed where. I mean, a lot of this stuff is already on chain. So if you have the ability to query various blockchains or protocols, you can see what wallets are holding what exposures inside of DeFi. And so to this day, we know right now where Celsius's breakpoints are on their BTC loans and on their ETH loans. So there is a benefit to knowing where those are, but there is no benefit if the folks who are underwriting those loans are outside the system. So I think there's a long way to go in terms of things like identity, things like how much collateralization, things like what is appropriate collateral inside of a system also still need to be worked out. But I'm optimistic. I think this experiment was ultimately still positive because the system still is very much running. So if that's true, then crypto has at least survived a major test here.
At the end of the day, the world lives in some version of fractional reserve banking. Citibank does not have all your money at once. And if everybody showed up, they're just not going to be able to satisfy the requests for the return of their capital. They've lent it out and they're managing it subject to some reserve ratio, leverage ratio, and it's clearly an ongoing and open question. Leading into the global financial crisis, it's very clear that these banks got way too big from a leverage standpoint. And I just remember in the aftermath of the GFC, there was a lot of people paraded around Capitol Hill, one of which was Alan Greenspan. And effectively, he told the Senate that his philosophy on markets, which was one of just pure self-governance and self-correction, turned out to be wrong, that you got to have more guardrails in place. Left to its own devices, the system is more likely to get too big and over-leveraged. In the case of DeFi, what does that process look like in terms of if there does need to be more thought process around the right level of collateral or leverage to be taken? How does that decision get made? Where does that come from?
I think it has to come through the code and through the smart contract that's issuing the leverage. And I'm still a believer that these systems will ultimately be able to find that equilibrium that allows it to essentially finance economic growth through the right amount of both leverage and then just natural underlying monetary supply. To your point about the GFC, certainly the housing market and the derivatives exposures that were created around it were the most visible piece of the puzzle. But I'm also a big believer that there is a massive Eurodollar system outside of the control of the Fed and US regulators that also is the major source of liquidity in the system. And that is just pure recursive lending in terms of the ability to create monetary units out of thin air using what essentially is either thin or US Treasury-based collateral. So for DeFi to essentially replace that system to ultimately grow into its promise of being both the store and the finance mechanism for value, if the future global economy really is internet-based, then again, to my point, identity really has to become like an important primitive in this system. And the ability to link wallets, know who is behind particular wallet positions and how much leverage they truly have, to your point, would go a long way in being able to kind of measure the risk in the system and how much risk is appropriate. One of the interesting kind of anecdotes that came out of these last few months were the number of analysts that were looking at total amount of lending that had happened on DeFi, and they noticed it had come down dramatically, but this is before the big unwinds in 3AC. And the mistake that was made was that people were looking at the concentration of debt that was still left in certain key wallets like Celsius and 3AC and others. And so the ability to identify and just know who the players are in the system, I think, will go a long way in terms of being able to let this system now flourish and fulfill its promise of being the true backbone of a new monetary system.
Well, I want to talk a bunch about what you're working on at Osprey and the kinds of products that you're developing for clients. Before we do that, let's just talk a little bit more about the risks now as the market tries to clear. You've got FTX lending a helping hand, so to speak, in some ways, trying to help the market clear. But there does still seem to be some risks of contagion, so to speak. What are the signs that you would look for to assess that the waters have gotten calmer and the risk of a real further meltdown in prices has diminished?
That's the everyday question that
Of
certainly
course.
keeps me up. From a market risk perspective, we've been trading sideways for almost a month now. And that's the stabilization of the drawdown that we experienced from the liquidations that we just talked about. So on the one hand, I feel like you can make the argument that a lot of the damage has been done. And so perhaps the market's in the process of finding a bottom. But if I overlay just my broader macro opinion on this market, I don't feel like we're out of the woods at all at this point. I think that the impact of the swing in liquidity that we've experienced over this last year or so, and the unprecedented tightening in financial conditions that have happened over that time period, still haven't fully worked themselves into asset prices. If I were still in equities, I would say that we've derated, but we haven't even seen the beginning of the earnings revision cycle to the downside. And I think crypto, for better or for worse, is still highly correlated with risk assets like some equities, or at least tech equities. And we're kind of at a period here where I think a lot of people are betting that the Fed might stop. They may see that inflation's easing and they can conclude this rate hike cycle, which would then allow risk assets to rip higher. I'm more in the bearish camp. I think that markets bottom roughly in line to slightly ahead of the broader economy, and I don't think we've seen the full pain yet from that. So that's just a long-winded way of saying that I don't really know where we go from here, but I think that I would not be surprised if, as conditions deteriorate a bit further without any type of easing from the Fed, that we're going to see another leg down in crypto, which, if you want to put this also in the context of kind of a first wave of technology that's happened here, what we just saw was a big speculative bubble that's not much different than a lot of speculative bubbles in history. My old boss on the Xylem side used to say that the market was essentially blind. Whenever there was something that needed to be financed, it would try to draw in as much capital as possible to finance it, but it didn't know when to stop. And eventually, when it did, it just would spit it back out. And we're in that kind of phase at the moment. So what you'll see here in crypto is a lot of things that go away, same way that speculative software went away in the 90s into 2000s. But I think some of the core business models will very much be here to stay in crypto. So having exposure to those core protocols and to the building blocks, kind of the next wave in crypto, I think are absolutely critical for investors.
It does seem to have a fair amount of similarity, as you note, to tech cycles where there's just overbuilding and things get too speculative. And as you say, certain of them just go away. So this will be the third or fourth, if it does materialize, crypto winter, as is being written more frequently these days. And so I'm curious, just in terms of the down periods where the excitement about price as a ratification of the power of it. It's always great to be long something exciting, especially when it's going up. But when you get into these sideways to down periods, there's still a lot of work being done, even if it doesn't show up in price. And that's where I'd love to go, and just to get you to think out loud about what does that next period of investment in the technology of this space look like? What are some of the promising initiatives that you see that'll make it stronger for the period that may emerge ultimately when things do return and a more bullish stance is able to be taken on? What does the investment from a technology standpoint look like over the next, let's say, 6 to 12 months?
I would frame my answer in the context of what was just built and then try to extrapolate from that. And what we just saw in this wave ahead of this winter has been the explosion of what they call layer one protocols. These are all base layers of crypto that are their own blockchain. They have their own universe of validators that run their software and build their blocks and confirm their transactions. And they all have various features to them that make one particularly better than the other. And Bitcoin, of course, is the original, but Bitcoin's functionality is somewhat limited. And then along came Ethereum, which, as I mentioned, had smart contract capability. So that has opened up the universe to building, and then a whole bunch of other protocols were built to try to displace Ethereum as the king of this base layer. crypto protocol. So I think what we've seen is the number of layer ones that are going to be invented have been invented. I don't think, unless someone comes up with a new novel way to create random numbers, I don't think anyone's going to have a better consensus mechanism than what's been currently built. And to be frank, the explosion of innovation that happened in this space over the last 2 or 3 years is just really astounding. People are going to look back in this period and they're going to look at some of the computer science that came out in this time as being truly remarkable, whether it's Avalanche's new consensus mechanism, whether it was the way that Polkadot is building cross-chain messaging, whether it's Solana's proof of history and the speed that they've come up with. So many really interesting innovations that came on the heels of Ethereum are really astounding. So now what do we do now? And the answer is, I think that the ecosystem very much keeps building up towards the application layer. And I think there's a huge opportunity here for middleware to express itself in the next cycle. I think there's a lot that needs to be done to connect these base layer protocols that essentially secure ownership of the internet to the use of the internet. And if the next generation of the internet is going to deliver on its promise to decentralize Web 2 or decentralize the major powers that have accumulated inside of kind of the current internet monopolies or oligopolies, then it's that middleware that's going to have to be built to allow the system to function more seamlessly for users. Right now, I don't know if you've played around much with DeFi or any type of applications in crypto, but it's even for people who do it all day, every day, it's still a daunting task at times to navigate through some of these bridges and various contracts, and not to mention the amount of hacks and other types of scams that happen, all make it ripe for some people to come along and create solutions to make it more user-friendly. And then the last but not least piece I'll mention here, I know I'm going a little bit long-winded here, but I think that NFTs as a technology are going to be also a major revolution that's just scratching the surface here now that we've laid down the protocol levels. People should definitely not sleep on NFTs. The idea that you can be bullish crypto but not be interested in NFTs is pretty incongruent. Like, they really are different sides of the same coin, and they're going to enable a lot of really amazing things in terms of what you can own from an intellectual property standpoint.
You're a lawyer by training, as you mentioned, and you just used the term intellectual property. So fast forward, 3 to 5 years on the NFT front. And if the investment in technology and innovation and then adoption ultimately materializes, what does that look like? What are some of those ownership opportunities for people in the NFT space?
Well, we are big believers that owning culture is really the first place to start with that. I think a lot of people look at this and they see the future of NFTs as being individual ownership entities where you can essentially own airline tickets or mortgages or you name it. And I think that will come. I think that's just going to take some time to get there. But I think the backbone of all of those systems, all of the innovation that's going to come later that will allow you to own things digitally will come from the backbone that's built to own native digital culture. And I think you've seen this before in a lot of kind of technological waves. Art usually tends to lead that. It tends to then create the tools that can be used later to own the more everyday assets. But where I'm excited is the ability to own native digital culture, the ability to own what will be internet native brands, internet native entertainment, internet native intellectual property. All of that right now is what NFTs enable. And that's something that we're heavily focused on.
Well, let's talk a little bit more about Osprey and the work that you and your partners are doing there. You're certainly doing some thought leadership. It's up on your website. You've got, in some ways, some framework for valuing certain projects or initiatives and tokens. I'm thinking back to your long, short days of assessing things from a fundamental standpoint. So first, tell us about Osprey, the firm, its founding, and then what it's doing on behalf of its investing clients.
Absolutely. Osprey is a digital native asset manager. We are very much focused on trying to bring the investor curated exposure to crypto assets. And by that, I mean, our initial roots and our initial product suite was and is the set of listed trusts that we created. Similar to Grayscale's GBTC, we have a listed Bitcoin trust, OBTC, and we then launched a series of other trusts that we think reflect the core assets of crypto from that protocol layer, base layer that I just described. So we have a listed trust on Polkadot, ODOT. We just listed our trust on Solana, OSOL, and then we have a few more in the pipeline, as well as some new ones that we're working on to bring to market. And those are really designed to give retail and other investors who are in platforms or in brokerage accounts the ability to access crypto in traditional markets through a listed equity. There is a tremendous amount of capital that are in those pools that would like to read crypto but cannot for either structural reasons or just personal reasons, because let's face it, going and custodying your own keys and buying crypto on exchange and all of those things are not particularly easy for people who just want to have a diversified portfolio. So we have been trying to create those exposures, and we're excited about continuing on that. Obviously, these products, they've had their controversies. And in particular, you have the issue of them trying to be ETFs and not being able to. At the moment, it's a fight that we're certainly involved in and would like to see the government come around on. I think that there is definitely an argument to be made as to why individual investors should be able to access this product in the most efficient way possible. And I think we offer that. So we'll see how it goes. But that's kind of our core offering at the moment. Our firm was founded by Greg King, who is a specialist in ETFs, exchange traded products. He was the inventor of the VIX ETN and the inverse VIX ETN. So he has a long history in creating ETPs. When Bitcoin was declared a commodity, a light went off in his head. This is something that could be put into a structured product and essentially given to people for access. Ironically, we were the ones who filed for the first futures traded Bitcoin ETF, and that was roundly denied back in 2017. And now it's the only thing that is allowed to be used in the market. So as the world turns. But in addition to that, we're creating a broader base of products for institutional and RIAs, which will basically give them a modular approach to crypto. So to investors who are at zero allocation, we make an argument that you should be considering increasing some exposure to crypto. The best way to start with that is Bitcoin or a combination of Bitcoin and ETH. So we offer two institutional funds. One's just Bitcoin only, one's ETH only. You can allocate between them. We're developing capability to make those into SMAs as well. So you would be able to own the underlying directly. And then we've developed what I call the next generation fund, which kind of goes to my point about getting exposure to a broader base of these emerging protocols, as well as the new kind of middlewares come. And then on the full active side of the spectrum, we have an NFT fund that we actively manage, and we're very excited about. We just launched that about a month ago. And so we've been entering the market these last few weeks and have been deploying capital, which sometimes it's better to be lucky than good. We managed to sidestep the downdraft in fundamental pricing. So we're sitting in a really good spot right now to get into the NFT market.
We mentioned some of the thought leadership that you guys have provided on your website and something of a framework for assessing the price of an initiative or a token. Is there any valuation framework that is emerging as a consensus? Is everyone kind of crafting their own version of it? Do you see some consensus essentially gathering in terms of how to do fundamental analysis in this space?
I think that there is a very rough consensus around looking at user growth as a way to evaluate kind of the fundamental strength of a protocol. Once you get past doing the actual due diligence on a particular project, if you look at the established protocols, whether it's Bitcoin or ETH or Polkadot or Solana, what we have done is really try to map out kind of the rate of user growth and then the future rate of user growth. And so we look at projects that are being launched in the ecosystem. We try to make assessments as to whether or not these will be particularly successful or what niche they're filling, or whether we think that's an area that has an addressable market that will allow for user growth that's either above what's currently being embedded into the protocol or not. And then in terms of how to value that user growth, I think there's a couple different ways to do it. In our reports, the one we've taken a stab at is to create a long-term user growth assumption, a base bull and a bear case of growth, and then use kind of a long-dated, smooth NVT ratio, which is similar to like a PE ratio in equities. And I recognize that this is a still highly speculative method given the volatility in the space. So you've had this NVT ratio jump around, which is why we tried to use a longer dated version of it. as well as using a 3-year-ish user growth estimate. And I think between those two things, we try to calibrate where we think that the price of the protocol token can go. And from our perspective, it's better to be roughly right than precisely wrong in this regard. So these are not estimates that are meant to be perfect rifle shot. It's really more about trying to calibrate what the potential token price can be. And I think the last piece of this puzzle, and I think something that people sleep on, is knowing what the protocol emission is, what the token emission is going to be. So it's just like knowing whether or not an equity or a company is going to buy back a lot of stock, or if they're going to issue a lot of stock, or if they're going to do a stock split, or what the unlock is for the various venture capitalists that finance the protocol. Just knowing what the token supply is going to be over that 3-year period is a critical piece of knowing what the token is going to be worth, and trying to take just a spot estimate of either how many tokens will exist in total or just at the moment is probably not the best idea. But so we try to adjust for that by doing the work and figuring out how much token supply is going to come out or disappear. In some cases, like Ethereum is actually going to end up being deflationary over the next 3 years, which is very bullish for it. So it's stuff like that, trying to calibrate where we end up. And we do a best effort to give investors some perspective on where we think the token price could go if these assumptions bear out. We're open to feedback. We're certainly trying to be as transparent as possible. We lay out all our assumptions for the model in each report, and we let people decide for themselves as to whether or not they want to make adjustments or accept or reject kind of what we say. So it's in that spirit that we're trying to value these tokens.
And it's clear that you and team are excited about the work you're doing in the NFT space. Anything else that you'd like to highlight where you're spending a lot of time, your curiosity's really been piqued, and you think you're onto something and really want to keep running with it, either from a research or product development standpoint?
Well, certainly the NFT space, that's, as you said, definitely something that we're highly focused on. And then from a general research space, we just actually published a report. Well, the last report we published was today, giving a highlight on the Polkadot Decoded conference that happened this last week and our takeaways on that. And before that, we did a deep dive into something called miner extracted value, or maximal extracted value, which is an interesting topic inside of crypto, which, not to get too deep in the weeds, but essentially allows people with certain software capabilities to front run transactions inside of crypto. And it's the nature of the system, and it will always be around. And we point out how it can be either used for good or bad, and who the actors are and what's going to happen next. And we're very interested to see how it goes. I think there's an opportunity for investors actually to capture some of that themselves, as opposed to give it away to the miners who've been pretty actively harvesting it in protocols like Ethereum these days. So it's stuff like that that we're always pushing the boundaries on, trying to figure out, trying to give people clarity on, and hopefully build products around.
Well, we can leave it there. I definitely have learned a lot, and I think our audience, who is definitely more traditional finance based, is going to get some takeaways from here as well. So Bill, I really appreciate you spending the time with us, and thanks so much for being a guest.
Thank you, Dean. Thank you for having me.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.